everybody. My name is Rob Domler. I'm a principal at Domler and Associates. I want to welcome you to our presentation today on mastering your retirement in any market condition. I've been in this business for 27 years as a certified financial planner, and it's incredible at times like this when we have a lot of concern and uncertainty. It's really where I really enjoy what I do. We focus on full holistic financial planning. The reason I love what I do is I get to know a lot of different people and I know their whole family situation. I get to know them as friends, and the more I understand them, the better planning I can do for them. So there's a lot of different people that have worked with us for many years, owned different businesses, have been professionals for a long time, and they've grown to trust us in handling their financial situation. And really, it's not just about the investments. I'm going to spend a lot of time talking about investment planning and investment emotional investing, but it's really about bringing peace of mind to their financial situation. That's our goal. Is I want my clients to be able to walk away and know that all their financial affairs are well looked after. So the biggest thing is the media's focus on probably a lot of the wrong things that we shouldn't be paying as much attention to. If we're looking at investments and markets and on a daily basis, these are things that we can't control. And so if we're going to spend all our time just looking at current market conditions, first of all, nobody knows what's going to happen tomorrow. And so we need to focus on the long-term financial plan. We need to stay the course through these difficult times. Too often you may know a lot of people that are reacting emotionally, and anytime we react emotionally, usually it's something we regret later on. And so we need to have strategies that are going to help us navigate through these difficult times. And so I'm going to talk a little bit about not just IG's approach, but our approach as a financial planning team. You're going to hear from myself, again, with 27 years experience as a certified financial planner, from my associate partner, Lucas Mertz, who's also a certified financial planner and has been in the business for 7 years. And at the end, you're going to hear from Jamie Buchan, who's been in the business for over 30 years. He's been an advisor. He's a business planner. He works with a lot of other advisors. And one of the biggest compliments is, that he works with us personally because he believes in what we do. So these are some of the things that we're going to cover today. And so right now, market volatility is kind of the talk of the day. The biggest piece is the only constant is change. Every time there's a market correction, there's a different reason for it. So I've heard many times in the last couple of months, people are saying, well, this time is different. And they're absolutely right. This virus that we're going through right now, we have to go back 100 years to see a similar time frame when you look at the Spanish flu. But what happens is every time there's a market correction, there's a different reason that caused it, but the market doesn't react differently. Okay, the reason this one was so significant is typically a market's going to go down about 6 months before a recession. This recession was immediate. We went from a very strong economy, and overnight that economy was shut down. So the recession was immediate. And so this drop in the market happened in 22 days. We had a correction, which typically takes about 8 weeks. So it was very unusual in its depth. But again, the market reaction and the market performance is not that unusual. We had a peak to trough drop of about 35%, which is not unusual when you have a significant market event or economic event like we did. This slide here, you can see I've circled back in 2009. This is when tax-free savings accounts came out. And I'll never forget is that we had the financial crisis of 2008. The markets were actually down 45% at that point in time. And everybody had this new investment option in Canada to invest into. At that point, we could put $5,000 into a tax-free savings account. And so many people wanted to put that money into money market funds because they were so scared of the market. The market was continuing to go down. And again, everybody was saying this time is different, but it wasn't. Ultimately, the economy returned to normal, and we had growth ever since. But everybody that put money into money market funds was getting 0% rate of return. I mean, zero. Inflation was higher than that. People were guaranteed to lose out by putting the money into money market funds. But if you invested in a equity investment at that time, you'll see on the next slide here is that the significant rates of return that happened on the market over the next 20 years. Next slide, please. You can see the S&P 500 since the end of December, so not quite the market bottom because the market bottom happened in March of 2009. But even from December 31st of 2008 till December 31st of this past year, the S&P 500, representing the 500 biggest companies in the United States, did 15.3%. Globally, all the numbers were very good. Canada and Europe were just under 10%, and the world indexes were around 12. So if you took the average, if you invested all your money in the equity markets, you would have averaged over 11.5%. The problem is nobody actually did this, is because we were so fearful of what happened before, we're constantly waiting for the next shoe to drop. And so you can see there's always another reason. This slide is great because, again, the media is a big part of this. As you can see, back the Acropolis now, that was when the pig nations of Europe, so Portugal, Italy, Greece, Spain, they were going broke. And so you had this big concern over the European Union collapsing, which is one of the biggest markets in the world. And everybody was fearful. The markets went down for a period of time. Then it moved on to the over the cliff, which is the fiscal cliff that happened in the United States. Because of the problems with their government, which we see every year continuing today, and the great divisions they have in there between the Democratic Party and the Republican Party, is there was no agreement on continuing to pay their debt. And so people were fearful that the U.S. government was going to stop paying their debt on January 1st of the following year because they didn't have any agreement politically. And they created this term called the fiscal cliff. It never existed before and hasn't even heard of this since. But again, the media jumps all over this with the fiscal cliff. And then we're talking about the next great recession, and we're talking about anarchy in the UK, which is Brexit. Then we've got the great American downgrade. And through all of this, even though you've got all these different reasons that the markets go down, the market continued to go up. Short term, we're on a roller coaster. There's ups and downs of the market. So this is what I was talking about before, is that this slide is showing you where everybody's been putting their money over the last 20 years, 12 years, since the 2008 financial crisis. The blue bars above the line is the money that's going into fixed income investments. So those are government bonds, mortgages, guaranteed investments. And you can see that $1.6 trillion has gone into these guaranteed investments, and $1.4 trillion has actually come out of equity investments. So while the market's gone up somewhere on average of over 11%, people have been putting more money into fixed income investments at the lowest interest rates in history. Okay, so emotionally, because we're so scared of what happened in 2008, we've been sitting in these fixed income investments, and so our portfolios haven't done nearly as well as if they'd been invested in the equity investments. So again, any kind of financial plan should have a balanced portfolio in there, depending on the risk profile of the client. But you can see here is people have been getting very fearful, and it's making them emotional, and they're making the wrong decision. And that's what's clearly shown in this chart over the last 12 years. Next slide. So now the question is, how bad is it going to get from here? I said earlier that this was the fastest correction in history. There was a 20% drop in 22 days. I'm very proud that our company was able to actually lead the industry in March when it came to net contributions to portfolios, because we actually had net positive contributions all the way through March. We see these drops as a significant opportunity. And in April, it was the best month on the market since the early 1970s. And so, yes, we had a very quick correction, but there was nothing we could do about it. But we had a significant rebound in April, and all our clients stayed on board. And by staying invested, they had significant returns in their portfolio. So despite all this negative news, which I'm going to talk about in a little bit, that negative news is actually getting a little better, the markets have been recovering. Because again, like I said earlier, typically the markets will predate what's happening in the economy by about 6 months. It was very unusual here because we literally went into a recession overnight. But typically the market today is pricing what they think is going to happen early next year. Now, the biggest piece is anyone that sits here, if you are going on any kind of presentation where somebody is telling you where they think the market's going to go, run as fast as you can, because ultimately they don't know. We've seen many situations where people predict. There's a company run by a guy by the name of Mitch Anthony who does a lot of retirement planning. And he showed they actually followed all the leading economists of the leading investment companies in America. And over a period of 3 years, they tracked all their predictions. And these leading economists, some of the smartest guys you're ever going to know, were correct 47% of the time. You'd have been better off flipping a coin than actually listening to these so-called experts. Nobody knows where the market's going to go. And the markets always recover. They go up and to the right. And that's what this chart shows. This is a longer term view. It's really looking at a 60-year period from the late 50s into 2020. And you can see all the little red circles. There's all these big drops. There's always something new that's going to make the market go down. but you still had an 8.93% annualized rate of return. So again, the negatives are always going to be there. And if I can look in the future and look back, anytime I'm in a situation where the market's dropped 20, 25, 40%, I've got to look at that as an opportunity. Depending on where I am in my life, don't run scared. It's like Warren Buffett said, be greedy when people are fearful and be fearful when people are greedy. When the markets are way up and people are getting greedy, you need to be careful. But at times like this, the smart money is being invested in good quality companies that are unfairly being punished today, even though they're actually finding great opportunity because everybody's adjusting to the new reality of the current economy. Next slide. This is why we invest for the long haul. This is a typical bell curve. And what I'm showing here, and I've highlighted a few of the years here. On the left, I've circled what happened in 2008. And you can see on the bottom is the rates of return on the market for that calendar year. And in 2008, the market was down between 30 and 40%. My point being is that if you looked at that as a great opportunity invested in the market, in 2009, which I have highlighted on the right with that bar, is that you had a 20 to 30% rebound. 2010, another 10 to 20%. And in 2011, another 0 to 10%. So if you looked at the end of 2008 and you invested in the market, the next 3 years would have been fantastic rates of return. So again, when you're making investment decisions, don't worry what's going to happen in the next 2 weeks or the next 4 weeks. I have lots of clients that ask me, hey, what's going to happen? What's going to happen? I have no idea. But ultimately, if I can look 3 years, 4 years down the road and look back, I know this is going to be a great opportunity for us to invest. 74% of the time the markets go up and only 26% of the time they go down. That's why investing in the market works for us. Next slide, please. So what we do is largely determined by our emotions. And so when we see these significant drops, what this chart is showing you here, and all these red little circles are showing you the intra-year drop. So you can see in literally every year since 1980, there is a significant drop on the market. There's a few years that are insignificant, but most years you're having somewhere around a 10 to 20% kind of drop in the market. I've circled two here, 1987 and in 2009. In 1987, if you remember the stock market crash that happened over mainly one day, Black Monday, but it happened over a couple of days, you had a significant 30% drop in 2 days. Okay. However, if you invested January 1st of 1987 and you came back January 1st of 1988, you'll have made 2% positive rates to return. So again, what did you do after those 2 days in October? You got to look at that as an opportunity. And in 2009, it's no different. So the market went significantly down in the financial crisis late in 2008, but it continued to go down in early 2009. So again, it was down 30%. But if you stayed invested January 1st of 2009 and came back January 1st of 2010, your rate of return would have been 23%. So again, when we were sitting there in March of 2009, I had to twist people's arms to say, no, don't buy the money market fund. You need to buy an equity investment. This is a golden opportunity. And that's what's happened most recently is with the market drop, we've had another golden opportunity to invest and make significant rates of return. Now, the biggest problem is when we emotionally invest and we pull ourselves out of the market when the markets are down, we can never recover. That's what this chart is showing here, is if you stay fully invested from 1999 to 2018, your rate of return was just under 6%. If you miss the 10 best days over that 20-year period, okay, 10 days in 20, that's 1 day every 2 years. If you missed that best day, your rate of return was cut down less than half. All right. Now, this market correction that happened in 2020 with the COVID crisis is a prime example. You had days in the market where they were going down 10%, but you had days where they were going up 10%. You cannot time that. Nobody can time that. And you can get crushed if you're trying to invest and you're letting your emotions take hold. So the key is the only way to success is to stay invested and stay in the market. Next slide, please. I'm going to show you a couple of different charts here, and this is what's happening in the COVID crisis here. And so you can see back in March, they shut down the economy in the middle of March, and consumer spending just dropped like a rock and went all the way down to a drop of nearly 37%. Okay, but what's happened since, and the market is reacting to this, is that consumer spending is recovering. Initially, a lot of people were in shock. This was very new. It was incredible the number of conversations I had back then as we were talking to different clients. But you can see that the economy is starting to rebound as people are starting to spend in the new world. They might be doing this online, but we'll talk about that in one of the future slides. But things are recovering, and that's why the market and the increase in the market is actually supported. Next slide, please. Consumers are spending on home improvement. So this is a very interesting thing that's happened here. Is if you look at that dark bar, that's really apparel, gifts, jewelry. Those are really the extras where I can picture going out in a nice suit, or if someone's buying a nice new necklace or whatever, or buying gifts. These are the kinds of things that have kind of dropped. They are recovering. You can see that bottom line is starting to come back up. But what's happened is how people are spending a lot of money on household improvements. If you've walked into any Canadian Tire or Home Depot in the most recent few weeks, you can see that they're busier than they've ever been. It's incredible how many people. We're going to have the nicest gardens in the world this year because everybody's at home doing all that extra work on their house instead of being out spending money on clothing and dining, which we'll see in the next slide. So this is the difference between grocery shopping and dining. And you can see that really it was a kind of even. There's a little bit increase in dining and groceries. And then obviously dining fell through the floor because we weren't allowed to go to restaurants anymore. And then grocery spending went way up. And so this was where we were lining up and we're wearing our masks and we're going to the grocery stores. And I know where I live, the Safeway was busier than it ever had been. And so everybody was spending a bunch of money on groceries. Now I'm going to make an argument. It wasn't just on toilet paper. It was on other things as well. But we've seen that bounce back as grocery spending went significantly down, and it's still increased for the year. But we're starting to see a rebound in dining. But that dining rebound is going to come as the economy continues to open and restaurants start to open. They're only opening at 50% capacity, but that's going to improve. And more people are getting comfortable with getting out and going to restaurants again. But you can see that there's the reaction to the what happened with the lockdown. So what can we do to protect our next nest egg? The most important thing, and we're going to get into some of these details next, is we need to have a plan and stick to it. We don't know what the markets are going to do. If you do not have a written financial plan, it's going to be very difficult not to react emotionally in these very strange times. And like I say, it's always a different reason that the markets go down, but it's important that we stick to our plan and ignore the markets. We need to have proper diversification. In Calgary, that's very difficult. A lot of people work in the oil patch. In the past, a lot of people had all their money in the oil patch. That's changed. We need to have money diversified all over the world in different asset classes, not just equities, but some fixed income, government bonds, as well as U.S. and international and emerging market equities. We need to invest for the long term. That's how we become successful. If we try and time the market, there's just too many things that can go wrong, and emotionally it's just very hard to do. Then we need to come up with a retirement income strategy. This is the thing that actually makes the biggest difference to the success of people's financial plans. Lucas is going to talk in a little bit about the percentages of success in people's financial plans. This one has one of the biggest impacts is make sure that we take out our retirement income in the best way possible to minimize taxation and to properly diversify our investments. And the next piece is professional advice. When things are going well, nobody feels like they need professional advice. If I'm healthy, I don't go see my doctor. But when I become unhealthy, then all of a sudden I'm relying on my doctor. And I'm looking at the financial services almost the same way as when things are going really well, you can pretty well throw a dartboard at an investment chart and pick any investment, you're going to do okay. It's times like this when the markets go down that you need professional advice. I argue that you need it all the time because that professional advisor that you trust needs to be there through all thick and thin, because we never know when difficult times are going to come, not just with respect to the markets, but things with sickness and health and in estate planning, all those things that can derail a financial plan. It's really important to have that professional advice. Next slide, please. So what does peace of mind look like in retirement? Well, one of the things that's happened is Canadians are living longer. And if you're a couple that is approaching 60 years of age, there's a 50% chance one of you will live beyond 90. So the biggest piece is when we're making investment decisions, and we might be retiring in the next couple of years, people get extremely conservative. And that's not necessarily the answer, because over the long haul, you still need to keep up with inflation. You could be retired for 30 years, for almost as long as you worked. Okay, so it's very important that we understand that there's a good likelihood that our retirement plan is going to be long. And so we got to make sure that we have a plan that's going to keep up with inflation, manage all the taxation, and we're going to get into a few other slides here to talk about some other concerns as we age. So this is something that's very important, and why financial planning becomes even more important once we're retired. The industry does surveys of clients, and it's really testing financial literacy. And we test a bunch of people between the ages of 60 and 94, and we give them some fairly straightforward financial questions. It's a 16-question quiz, and on average, between the ages of 60 and 94, they get 58% of the questions right. But the mean score for people over 80 is only 18%. Okay, so as we age, the unfortunate reality is we have a little bit less knowledge when it comes to financial capacity. That's just natural. As time goes and financial literacy becomes more difficult and there's more different types of products and stuff, it's difficult as we age to stay on top of that. So again, with financial planning for retirement, I like to break it down into really 3 stages. When we're younger and healthier, we're doing more. We call that your go-go years. When we're in, say, around 75, we call that our slow-go years. We might spend time closer to home with our family. And then as we get older, unfortunately, we call that your no-go years, where we might be more in a retirement home, staying really close to home and spending a lot less. And so your financial plan needs to adjust all of that. So the biggest problem is, as financial literacy goes down, our confidence goes up. And we actually think we're smarter than we are. And so the biggest piece is we've got to make sure we're doing sound financial planning in our 50s and 60s, and we have a sound, trusted financial advisor or family member that's helping us through all of this, because they need to be there when we're older. I can talk about story after story of clients I've had for 27 years that when they were 60, things were great, but now in their mid 80s, that we're having some difficulty because of just decreased capacity. So it's very important that we have sound financial planning and a trusted advisor. Next slide, please. This is the impact of inflation over the long haul. Now, inflation is very low today, but this shouldn't surprise anybody. I know when I was a kid, I only needed a dime or 25 cents to go get a bag of chips. And it was hard to find that dime or that quarter. Well, today, you can find that in your change drawer in the middle of your car. You'll have dollars of change and stuff like that. So, things cost a lot more today than they did a long time ago. And so if you're going to be retired for 30 years, we've got to be prepared for the increases in costs. A lot of that could be medical as well, as we continue to have more needs down the road for medical support. So that, again, is something that's really important, that your financial plan deals with that. Another piece that can impact our long-term plan, and this is something that Lucas is going to focus on as we move forward from here, but if we get into retirement and we have poor early performance, it can really adjust our long-term plan and impact the success of that plan. And so we need to make sure that, typically with my clients, I like to have 1 year of money that's kind of set aside, that's in a safe place, that if the markets have a difficult year, we can leave the money invested and let it recover, and we can use some of the more conservative money. And so you got to be prepared. It's not that this situation is unusual. It happens too regularly. So we've got to make sure our financial plan is prepared to weather the storm through these market corrections. And so with a lot of clients, what we've done is we've adjusted in the 3-month period while the market went down and now is recovering. We've adjusted where we're getting their retirement income from, and then we'll kick it back in once the markets are recovered, which we've seen.